A Chinese billionaire just placed a $300 million bet that silver will collapse. At the exact same moment, the Trump administration assembled 54 nations in a closed-door meeting to restructure the entire global metals market. One of these forces is about to be violently wrong. And what happens next will determine whether your savings survive the next 12 months or vanish into monetary dust. This is not speculation. This is pattern recognition. And the pattern has never been broken. Bian Shiming, low-profile Chinese trader, made nearly $3 billion from bullish gold trades over the past 2 years. Now he has taken the Shanghai Futures Exchange's largest net short position on silver, $300 million, 30,000 contracts, 450 tons of silver he is betting against. His timing was surgical. Silver dropped 16% in recent weeks. His paper gains have already swelled. But here is what makes this extraordinary. While Bian Shiming was establishing his short position, J.D. Vance and Marco Rubio convened representatives from 54 countries for what they called a critical minerals ministerial meeting. 54 nations, representing roughly 2/3 of global GDP, all gathered to discuss one thing: taking back control of critical mineral supply chains and pricing mechanisms from concentrated foreign influence. When they say critical minerals, understand what they mean: physical silver, physical gold, physical cobalt, physical lithium, the hard assets that power militaries, electronics, solar panels, and monetary systems. President Trump is not going to allow China to corner the silver market. That is not opinion. That is stated policy. And the tools to enforce it have just been deployed. Let me show you how this works. The global structural silver supply deficit can only be resolved 3 ways: higher prices to incentivize new production, increased mining output through policy support, or decreased demand by cutting off access to the metal itself. The Trump administration just fired all 3 weapons simultaneously. At the ministerial meeting, J.D. Vance did not mince words. He stated clearly that international critical minerals markets are failing to create sustainable domestic industries, failing to secure supply chains, and failing because of concentrated supply and persistently suppressed commodity prices influenced by forces outside any single nation's control. He acknowledged that mining projects stall and fail constantly because pricing is erratic and unpredictable, making consistent investment nearly impossible. Then he said the goal is to stabilize pricing to enable domestic supply chain development. Read between those lines. The United States government has officially acknowledged that current market pricing mechanisms in critical minerals are dysfunctional and require intervention. They are saying out loud that prices have been artificially suppressed, and they are going to fix it, not with hope, with policy. This is the counter-move to Bian Shiming's short. While he bets $300 million that paper silver crashes, Trump's team is building a price floor system and restructuring the entire physical market to cut off Chinese access and secure domestic supply. Same pattern, same sequence, same outcome. You have seen this before. Rome debased its currency to fund wars and bread subsidies. The silver content of the denarius dropped from 95% to less than 5% over 2 centuries. The empire collapsed. Verified. The Dutch Empire financed endless wars against Spain, France, and England. Debt exploded. The guilder lost reserve status. Amsterdam went from the world's financial center to a regional port. The empire collapsed. Verified. The British Empire fought 2 world wars, accumulated crushing debt, and lost reserve currency status to the United States in 1944. Sterling devalued. The empire collapsed. Verified. Every empire follows the same script: overextend militarily, finance wars with debt, debase the currency, lose reserve status, collapse. The sequence is mathematical. It is not a theory, it is a law. And the United States is now in the final act of that same play. Here is where we are right now. The U.S. national debt is $36 trillion. Interest payments alone exceed $1 trillion annually. That is more than the defense budget. The government is now borrowing money just to pay interest on money it already borrowed. That is not fiscal policy. That is a Ponzi scheme. The dollar is collapsing at the fastest pace since 1980. Just 1 year ago, the dollar was the strongest performer across all G10 currencies. Today, it is the second worst. The Australian dollar is up 8% against it. The Swedish krona is up over 10%. The New Zealand dollar is up more than 5%. Capital is fleeing, not slowly, violently. Treasury Secretary Bessent acknowledged hearing reports that China is developing digital assets backed by physical commodities, specifically for international payments and reserve purposes, to bypass the dollar entirely. Meanwhile, China's actions speak louder than any rumor. Gold reserves have reached all-time highs at 74.1 million ounces. U.S. Treasury holdings have dropped to $682.6 billion, the lowest in 18 years. China has reduced its treasury position by over $600 billion since the 2013 peak, while simultaneously doubling its gold reserves. They are not rotating out of dollars into other paper. They are rotating into physical metal, and they are not alone. We are not at the cliff. We have already walked off it. The only question is, how long before we look down? Every major asset class is crashing simultaneously. The crypto market hit a record $4.3 trillion in market cap on October 6th. Today, it is worth $2.3 trillion. $2 trillion of value erased in 4 months, 46% gone. Bitcoin just dropped below its 2021 all-time high. U.S. stocks are collapsing. The Nasdaq is down 1.34%, wiping out $517 billion. The S&P is down 1.13%, erasing $695 billion. The Russell 2000 is down 1.5%, losing $47 billion. Labor data is terrible. Initial jobless claims rose to 231,000 versus 212,000 expected. January job cuts were the highest since 2009. Companies announced very few new hiring plans. When layoffs rise and hiring slows together, that is a leading indicator of economic collapse. Markets are pricing that risk right now. Every asset on Earth is crashing at the same time. That does not happen in a free market. It only happens under extreme stress or extreme manipulation, or both. But here's the twist. While paper markets are imploding, physical silver is vanishing. Australian bullion dealer Citigold halted all silver sales due to a global silver shortage. Not a temporary demand spike, an actual shortage, forcing dealers to stop selling entirely. India's multi-commodity exchange hiked silver margins by 7% and gold margins by 3%. Exchanges do not raise margins out of comfort. They do it out of fear. If gold were the problem, gold margins would be hit harder. They are not. Silver is. High margins equal stress. Stress equals positioning risk. Positioning risk means too many traders are on the wrong side of the bet. They are not protecting investors. They are protecting the system from a squeeze. The market is telling you what it fears. And it is not gold. COMEX silver deliveries are relentless. Another 608 delivery notices were issued Wednesday. JP Morgan issued 531 and stopped 239. Total COMEX February silver deliveries have risen to 3,563 contracts, which is 17.815 million ounces, just 4 days into a non-primary delivery month. COMEX gold deliveries show 2,692 February notices issued Wednesday. Barclays issued 1,304. JP Morgan stopped 740. Citigroup stopped 1,000. Total February gold notices rose to 32,004 contracts, 3.2 million ounces. Physical demand is not slowing. It is accelerating. And here's the war. Silver is trading nearly 80 cents per ounce in backwardation after a historic price slam. Spot silver is currently trading approximately 80 cents above the front month March futures contract. That is a sign of massive shortage of physical silver in the market right now. Backwardation means you pay more for silver today than you pay for silver 3 months from now. That only happens when physical metal is desperately tight and nobody wants to wait. It is the market screaming that paper price and physical availability have completely disconnected. Western spot silver is $70. Shanghai spot is $81. Shanghai futures are $99. The Shanghai premium is $11. That premium exists because China cannot get enough physical metal. They are paying more, much more. And still, supply is tight. You cannot unsee this. Paper is crashing. Physical is disappearing. That is not a contradiction. That is the setup for a violent short squeeze. The coordinated smash of derivatives in silver and other critical minerals was timed right before this 54-country meeting. That is not coincidence. That is strategy. We are witnessing a coordinated worldwide reset in critical minerals from discovery to market to production. This was not a random meeting. J.D. Vance and Marco Rubio did not host 54 nations for table setting or symbolic trade deals. This was planned and coordinated. The smash in paper silver happened right before they announced the new policy framework. Why? Because the old system is being dismantled, and someone wants to exit their positions before the floor gets pulled out, or someone wants to accumulate physical before the price floor is implemented. Either way, the timing tells you everything. While BN Shiming shorts $300 million of paper silver, the Trump administration is establishing a price floor system and restructuring the entire global critical minerals market. These are opposing forces of extraordinary magnitude. One of them will be crushed. When sentiment becomes excessively bullish, buyer exhaustion can trigger pullbacks even in structurally tight markets. That has happened repeatedly since the 2022 cycle low, always followed by a resumption of the uptrend. The current situation shows this tension clearly. Fundamental tightness is real. Physical shortages, dealer halts, backwardation, policy shifts designed to support production. But short-term positioning became crowded. Leverage was extreme. The Chinese billionaire's $300 million short, the exchange margin hikes, and the forced liquidations all reflect that crowding. Markets got too one-sided, and when markets get too one-sided, they purge. Technical indicators across risk assets show deeply oversold conditions similar to previous major bottoms. But oversold markets can remain oversold during deleveraging events. The stock market is seeing the most fear in almost 2 months. Volatility is everywhere. The contrast between collapsing paper prices and intensifying physical scarcity creates the classic divergence that defines these markets. This is not new. This is the same script that played out in 2008 and 2011 and 2020. Paper dumps, physical tightens, then paper catches up violently. China and the United States are now competing directly over critical minerals markets, with both sides implementing strategic policy measures. The meeting with 54 countries, the J.D. Vance statements that manipulation is ending, the price floor system, the focus on making critical minerals markets predictable and independent from concentrated control. All of this is the countermove. While Bian Shiming shorts $300 million of paper contracts, the Trump administration is restructuring the entire physical market to cut off Chinese access and ensure domestic supply. 3 weapons deployed simultaneously, higher prices to incentivize production, policy support for mining projects, and cutting off Chinese access to Western-sourced metal not might happen, will happen. This is stated policy from the second highest ranking official in the United States government. The smart money is leaving paper and moving into physical, not because of hype, because of policy. Here are the 3 forces colliding right now. First, Bian Shiming shorts $300 million in silver, 450 tons, 30,000 contracts. He made $3 billion on gold. Now he is betting big against silver. But the Trump administration fires back. J.D. Vance hosts 54 countries, representing 2/3 of global GDP. He states that manipulation is ending. Prices need to be predictable. Supply chains need to be independent. A price floor system is coming. China will not be allowed to corner the silver market. The physical weapons have been deployed. Higher prices, increased production, cutting Chinese access, all 3 fired simultaneously. Second, the physical shortage is accelerating despite the paper crash. Australian dealers are halting sales due to a global shortage. India raised margins 7% on silver and 3% on gold, 17.8 million ounces in COMEX deliveries in just 4 days of a non-primary delivery month. Silver is in backwardation by 80 cents after the price slam. Physical is desperate, while paper dumps. The dollar is dumping at the fastest pace since 1980. Crypto is down 46%, with $2 trillion wiped out. Job cuts are the highest since 2009. Everything is crashing, but physical silver is disappearing. Besant confirmed rumors of a China gold-backed token. China is dumping treasuries and doubling gold reserves. Not opinion, pattern recognition. Third, the coordinated smash was timed right before the 54-country ministerial. A worldwide reset in critical minerals is underway. Manipulation is ending, per official U.S. policy. But sentiment got too bullish. Leverage was extreme. The Chinese billionaire saw a short opportunity in the paper market. Markets are oversold. Analysts are saying this is temporary, like every correction since 2022. The next rally will be much bigger. Mining stocks are undervalued. Fortunes are coming, but short-term pain is real as positions unwind. Here is the unresolved tension. Does Bian Shiming's $300 million short get squeezed as Trump's price floor is implemented and the physical shortage intensifies? Or does deleveraging continue, pushing prices lower before structural forces take over? Exchanges are raising margins. Forced selling is possible. But J.D. Vance is stating that manipulation must end. Price floors are coming. 54 countries are coordinating. Physical dealers are halting sales. Backwardation is 80 cents. Who wins? A Chinese billionaire's $300 million paper short, a Trump administration supply chain restructuring, and a global physical shortage that refuses to disappear are not isolated headlines. They are interconnected signals inside a financial system under growing strain, and the order in which they unfold will determine everything. It will decide whether prices flush lower in one final wave of panic, or whether this moment marks the bottom before policy shifts reset the entire landscape. History is clear on one point. Physical always wins. Paper can be manipulated, leveraged, and printed into oblivion, but physical supply is governed by geology, energy, labor, and time. You cannot create gold, silver, or copper with a keystroke. It must be mined, refined, and transported. That reality never changes. What does change is the path from paper illusion to physical truth, and that path is rarely smooth. It is usually violent. Right now, sentiment has reached extremes. Fear dominates markets. Leverage is unwinding across asset classes. A major Chinese billionaire has placed a massive short position, signaling aggressive speculation on further downside, while, at the same time, the Trump administration is advancing its critical minerals initiative, openly acknowledging structural weaknesses and market dysfunction. Officials are talking about reshoring production, securing strategic resources, and insulating supply chains from geopolitical risk. These are not random policy moves. They are responses to real stress beneath the surface. Meanwhile, physical shortage indicators remain present. Backwardation continues to appear in key metals, confirming tightness in spot markets. When buyers are willing to pay more today than tomorrow, it signals urgency and scarcity. That does not happen in balanced systems. It happens when supply is failing to meet demand. This is not an environment for reckless speculation. It is an environment that rewards discipline and punishes emotion. This is a time for cold logic. Every participant must know which time frame they are operating in. If you are trading paper contracts with leverage, you are in a demolition derby. There are no safety nets. Margin calls do not care about your thesis. Forced liquidations do not care about long-term fundamentals. They do not care about shortages, central bank buying, or government policy. They care only about price and liquidity in the moment. If you are oversized, overleveraged, and trading without a plan, these markets will destroy you. That is not pessimism. That is mathematics. But if you are accumulating physical metal for the long term, this volatility is noise. It is the same chaos that appears at every major bottom. It appeared in 2008, in 2012, and in 2020. The same fear, the same panic, the same forced selling, and the same divergence between paper prices and physical availability. And every time, physical won. Not might, not maybe, will. The wealth transfer is already happening. It is not something that will arrive in the future. It is taking place right now, quietly and relentlessly. Capital is moving from the uninformed to the prepared, from short-term speculators to long-term planners, and from paper holders to asset owners. The real question is which side you're on. Are you holding digital promises that depend on functioning systems, solvent counterparties, and political stability? Or are you holding assets that exist outside the financial grid, require no permission, and have survived every empire collapse in recorded history? Gold, silver, land, and strategic resources represent hard assets with no counterparty risk. That is not speculation. That is a survival strategy in an unstable monetary environment. The so-called smart money already understands this. Central banks are buying gold at the fastest pace in decades. China continues increasing reserves while reducing exposure to U.S. treasuries. Sovereign wealth funds are reallocating away from fiat-heavy portfolios and into commodities, infrastructure, and tangible assets. These institutions manage trillions of dollars. They do not move on emotion. They move on long-term risk models, historical precedent, and structural analysis. They are not doing this because of online commentary. They are doing it because they recognize the same pattern repeating itself. Excessive debt, currency debasement, geopolitical fragmentation, supply chain nationalism, and declining trust in institutions. The sequence is always the same, and so is the outcome. Paper burns, metal survives. This is why education matters. This is why independent thinking matters. What is coming is not a routine market correction. It is a slow-motion monetary realignment that will redefine how value is stored, transferred, and protected. Some will see it early and position accordingly. Most will only realize it after the rules have changed. Do your own due diligence. Understand your risks. Know your time horizon. Separate signal from noise. Invest with logic, not hype. Use your own brain. Do not follow anyone blindly. But understand this truth. The pattern has never been broken, not once in modern financial history, and it will not be broken now.